Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, and now today we're going to be discussing the GDP data that just came out. It's not just for the Q3 of this financial year, it's also the second advance estimates for this year, but the revisions that have been made to the data for the previous year as well. So we have the second revised estimates for 2022-23 and the first revised estimates for 2023-24. So there's a lot of data there, a lot of revisions have happened. So what the economy looks like, that's what we're going to discuss today. And to do that, we have with you Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's start with the most recent, which would be the Q3 data. Uh, Now, was the growth in this quarter up to expectation? Because I know Q1 and Q2 were lower than expected. So was Q3 what at did it meet expectations? And sectorally, what was the performance like?
Yeah, so it did meet expectation because there was this expectation that from Q2 there will be an improvement.
Hmm.
Because in quarter two, as per the original estimates, growth was 5.4%, which got revised to 5.6%
Right.
when the Q3 numbers came out. But there was this expectation that growth will improve from those levels, primarily due to improvement in consumption, because October, December happens to be a period of festivals and weddings, and also because of a sharp improvement in government capex, because we saw during the first two quarters that government capex was not up to expectation. So there was improvement as per the CGA data. We saw that there was improvement in government capital formation. Also, if we look at from the external sector point of view, exports, particularly non-oil exports, were doing well. So these were the key drivers that were expected to push up the GDP growth, and therefore we saw that GDP growth came in on expected lines at 6.2%.
Right.
The second question, sectorally, if we see that agriculture has performed exceptionally well at 5.6%, and it is the second quarter where agriculture's growth is outpacing manufacturing sector's growth, and
Or to put it the other way, where manufacturing has been slower than
slower than
agriculture.
agriculture, yes. So that is the key highlight. The other is that manufacturing sector has improved from the previous quarter, but again it's the growth is not very high. It is just sluggish at 3.5%, and there are various reasons for that. A part of it is also driven by base effect, because
Yes.
the December quarter of last financial year we saw a huge upsurge in profits,
Hmm.
and therefore, and since then, profits, particularly of manufacturing sector firms that are a critical input into the GVA manufacturing calculation, they have remained at elevated levels since that time, and therefore, in growth terms, we do not see much variation because profits are already at quite an elevated level.
Right.
At around, if we see in level terms, aggregate profit, operating profits are around 2.2 lakh crore. So that is a big number. So that was expected. On services side, we see that growth has remained more or less stable in comparison to the second quarter at around 7.4%. And there also there are sectoral variations. The trade, hotel, transport, communication sector growth was 6.7%, and the various high frequency indicators were showing a mixed picture. Hotel occupancy was doing well, civil aviation indicators were doing well,
Right.
whereas port indicators were not doing that well. So it was expected to be on around 6.7%. Financial sector is mainly impacted by the credit and deposit growth, and we know that credit growth has been slowing down, and therefore we see that even RBI has reversed uh, the hike in the risk weights that they had
Correct.
introduced on
They're
NBFC
trying to open
lending,
up credit
trying
again.
to open up credit again, trying to ease up the constraint on credit, because
Mm.
credit growth has been visibly slowing down. Public administration, the other important big part of services, grew at 8.8%, and that is mainly to do with revenue expenditure. It's mainly captures the revenue expenditure. Um both of the center and the states, but primarily I think mainly this increase that we are seeing is due to the states increase in revenue expenditure in October, December.
Right. Okay. And the construction sector is another
Yes,
important
sorry.
one,
Yeah,
right?
construction sector is a pain point where we see that the construction sector was growing at around 9 to 10% for consecutive quarters, and
Yeah.
now we see that construction sector grew by 7%, and there are various reasons for that. One being that steel and cement prices are depressed. Steel prices
Hmm.
particularly is going down due to dumping by Chinese cheap
Right.
imports, and the other important there are various other factors. Like one is that the award of road projects have slowed down in this year and in the previous year. So moving forward also, we do not expect that construction activity will be very strong. There could be some instances, there could be some signs of slowdown in construction activity. And also, if we look at the picture that is emerging from the real estate, there also we see that the observers, the commentators are noting that real estate sector has reached its peak,
Right.
and now the prices are going down. So all these factors in conjunction are leading to a slowdown in the construction sector. So that's from the activity side.
Right.
From the expenditure lens, we see that consumption has picked up as compared to the previous quarter.
Yeah.
Part of it is driven by rural consumption, and also due to festivals and wedding, we saw
Hmm.
that there is an increase in consumption in quarter 3. But the worrying aspect is that investment has not picked up. So it's around
Yeah.
5.8, 5.7%. It's not picked up. That is mainly due to private sector and states. So while the central government capex has picked up, states capex has not picked up. And in fact, April to January period shows that states capex has actually contracted. This is despite central government devolving its amounts to states. We don't see a pickup in states
And also
capex.
giving those interest-free loans and all
Those
of those
interest free
things.
loans, yes.
Yeah.
So front loading a lot of devolution has not translated into higher capex. At least the data till January is showing that.
Hmm.
And private investment has remained patchy. We see various indicators are pointing towards that. There is in the RBI bulletin gives a very interesting data which is on the project finance.
Right.
So that shows that how much amount is sanctioned for construction for project finance, and there we see that the amount is 98,000 crore for the December quarter, and for the corresponding quarter of last financial year it was 97,000 crore. So we don't see a very appreciable
No
increase there.
increase. Right.
The industrial outlook survey also shows that only one third of the respondents expect that there will be an increase in capacity utilization.
Hmm.
So overall, and that is expected, consumption uneven, export demand uneven, uncertain, unpredictability, policy uncertainty to is rising. All of these contributing to private investment not picking up.
Right. And so now that's the Q3
Correct.
data.
Yeah.
But the government also released its second advance estimates for the full financial year.
Right.
The first advance estimates came out in January,
January.
second one came out now. Now we have the Q1, Q2, and Q3 data, which means that any growth that has to happen in Q4.
Correct.
So, what are they expecting in Q4, and do you think that this is a realistic?
Yeah, so based on the, so now second advance estimate pegged the growth for the full year at 6.5%,
Hmm.
which is marginally higher than what was expected in the month of January, 6.4%. And this assumed that in the fourth quarter growth will be 7.6%. So
Right.
now that seems to be highly optimistic because of the various challenges that we are seeing on the external front. Now, we may argue that Trump's tariffs impact will kick in from the next financial year, but that is true. But even now, the impact is already being felt in the U.S. economy.
Right.
If we see the various indicators in the U.S., their nowcast is showing a contraction for the January to March quarter. GDP is going to contract. So the kind of exceptionalism narrative that we were talking about till now, that within advanced economies, the U.S. economy is growing at a very strong pace, that may not hold true going forward.
Hmm.
So US economy is slowing down, inflation is rising, bond yields are rising, consumer sentiments are going down. So if the US economy slows, that will have an impact on India as well, because US is our major export market. So that is one, and it has implications for other sectors as well.
Right.
So 7.6% growth is looks optimistic, because investment has also not seen signs of pickup. So on the external front, there are challenges. On the domestic front, by implication, there are challenges in terms of investment. So 7.6 does look a challenging number, and when we'll have the provisional estimates for the current year that will come out in the month of May, we
Right.
might see a downward revision of the overall growth rate. When
Okay.
we'll have the full 12 months data,
Right.
and then we might see the full impact of Trump's policy. So there could be a slowdown in the growth assumption.
Okay. And now, are there any other revisions in the second advance estimates as compared to the first estimates?
Yes, so there are these changes, and you see the time gap is not very much. It's
Right. It's
not
about
even
a
two
month.
months.
Yeah.
So 7th January and 28th February. So it's
Right.
not even
Not
two
even
months.
2 months.
So what we see is that the projection from the expenditure side, we see that now, as per the second advance estimates, consumption is expected to do better by 30
Mhm.
basis points. Investment is expected to be lower as compared to what was projected during the first advance estimate. So again, investment is going to be a pain point going forward, as projected by the second advance estimates as well. On the export side, which again is which looks optimistic, is that the projection for exports has been raised by 120 basis points. So now exports are projected to grow by more than 7% in the second advance estimate. That again looks a bit optimistic. Yes, till now exports are growing. Non-oil exports are strong. Services exports are buoyant, but we need to see whether that trajectory which we have seen till now will be maintained in the remaining months of the current financial year as well. So those are the key changes from the activity, from the expenditure side. From the activity side, the manufacturing sector growth has been scaled down by 1%. So it was
Right.
expected at 5.3, now 4.3. Manufacturing sector has been growth has been scaled down, and again, a part of it is driven by base effect, because for the previous financial year the growth has been scaled up. The projection has
Right.
been
It was
scaled.
in double
It's
digits.
in double digits.
Yeah.
So that is having an impact. That in fact, the overall contribution, if we try to segregate, the impact of the base effect is almost 50%. So
Okay.
that is something that we need to bear in mind, and therefore, in addition to the year-on-year change, it's very important to look at the levels, the absolute numbers, also to get a correct sense.
Yeah. Right. And even the consumption, you said that the figure has been
Revised up,
increased by
yes.
30 basis
Yeah,
points.
that again is optimistic, because on the
Right.
one side, manufacturing sector has been the manufacturing sector projection has been reduced by the 1%. So it is optimistic whether that
And
can be
especially,
achieved.
what could they have learnt in a month and a half that is suddenly
Yeah,
revising
so
their
they are
data
betting
upwards?
on rural consumption, which is true that again agriculture's growth has been revised up
Right.
from 3.8 to 4.6. So
Hmm.
mainly the buoyancy that we are seeing on the statistics office is seeing is mainly coming from the rural sector, because kharif output has been good.
Hmm.
Rabi output is expected to be good, so that is something which is giving a momentum to overall consumption story. So I think that it is coming from there.
From there.
Urban
Right.
consumption continues to remain mixed. There are concerns in several pockets of urban consumption, but on rural consumption, the strength continues, and that is something which is, I think, spilling over into the optimistic numbers.
Right. And no, it's good news that that rural consumption is still going strong.
Yeah. And
B-
it is expected to be sustained, I think, in the next year as well,
Right.
with agriculture being on a bright spot.
Absolutely. And okay, so let's talk about some of the other revisions that have been made. As
Right.
I mentioned, the second revised estimates for 2022-23 and the first revised estimates for 2023-24.
Correct.
Now, without going into too much granular data, but what have these revisions looked like for the last two
So
years?
for FY24, that's the last financial year, the growth, earlier growth projected was 8.2. Now it
Hmm.
is expected at 9.2.
9.2.
So
Right.
what has changed? So earlier we had provisional estimates that were released in the month of May of last year. Now we have first revised estimates. So a new data set come. Now we have the MCA 21 data set. We
Hmm.
have the data from departmental enterprises. We may have data on unlisted enterprises. So that has resulted in a revision. But there is a big revision from 8.2 to 9.2% growth, and so that is on the FY24 number. But what is more baffling is actually the FY23, because
Okay.
there we have the numbers are both are revised estimates. One is first revised estimate, and now we have the second revised estimate, which are now also, by the way, called final
Final
estimates,
estimates.
because earlier government used to release the third revised estimates also,
Right.
but now that practice has been
Yeah.
discontinued.
The second is the
Second
final.
is the final.
Yeah.
So there is a difference of 0.6% in the from first revised estimate to second revised estimates in FY23. And now here, if we, without, as you said, growing into the granular detail, if we just pick up one sector like manufacturing sector, and if we look at some of the subsectors, we see that some of the subsectors which were earlier seen to be showing a negative growth is now showing a very sharp positive growth. So things like in food products, in metals, we see a very wide variation between the first revised estimates and second revised estimates. Now, we don't expect, normally if we look at the data, we don't expect very wide variation between first RE and second RE. The data revision is expected to be more prominent from the provisional estimates to first revised estimates,
Right.
because the entire information set changes. We are gradually moving from indicator based approach to actual data set. Advanced estimates, we are doing benchmarking, then we have 12 months data for the provisional estimates, and then we are moving to actual data. We have access to some surveys also, but it is not expected to have very wide variation in the revised estimates per se. But here we
Between
are
the
seeing
first and the
between
second.
the first and the second, because it's not clear what is the new information flow that is coming in the second revised estimates as compared to the first. They may have access to some more surveys, but again, this data gap is something that should be minimized, and it has implications for the advanced estimates as well. Something needs to be done, because there is no predictability in the revision cycle. You start from advanced estimates and
Right.
you end up at final estimates. There is a big gap. So the indicator approach and the final estimates, some level of alignment needs to be done so that there is some predictability over the revision cycle.
No, of course, it would affect policy making as
Policy
well, right?
making, intervention, it's very difficult to assess the economic momentum. And if the economy is growing at 9.2% in the last year and now it's growing at 6.5, there is a very steep slowdown
Right.
since then. So what kind of policy is expected as compared to when we earlier thought that the economy was growing at 8.2 and now it has slowed to 6.5%? So the entire assessment becomes very difficult to assess the underlying economic momentum, and hence the formulation of policy.
Right. And now I know that there is this is a question that most people will have, and I know it'll be very tough for you to answer, but this data, all of it, you feel is credible? The
So credibility is there, because the thing is that we know what sources are there.
Right.
Yeah, but the thing is that you need to see that the revisions are minimized. If what needs to be done now is that the advanced estimates, your initial estimates, something needs to be done so that they are aligned with the final estimates, because your initial
Yeah.
estimates are showing something else, and ultimately there is almost a 1.3 to 1.5% gap between your first advanced
Yeah.
estimates to your final estimates,
Which is huge.
which is huge. So one thing is that there should be more transparency in disseminating what exactly are the data sources that are there for each and every round of revision. First advanced estimates to second to provisional to first to second revised estimate.
Right.
We broadly know what are the information sources, but it will be good to have a more granular discussion on what actually is the new information source that is there from first RE to second RE. So all those things will help us in trying to understand the underlying momentum. Maybe what it tells us is that the unlisted sector did well, because that is resulting in
Right.
an increase in the manufacturing sector performance has improved after incorporation of more data. So that is what it is telling us. So that means that your initial estimates is not giving you a correct picture. Something needs to
Yeah.
be done to align your initial and the final estimates. Your benchmark indicator approach needs to capture something about the informal or the unlisted sector, so that there is some parity, some semblance with the final estimates.
Absolutely. So that over time, when you're making plans, because there is a quite a time
Gap,
gap
yeah,
as well between the
yes.
first advance estimates and the your final.
Final, yes,
Yeah.
yes.
Right. So okay, I have a few questions from the audience. Saurabh asks, with exports being revised downwards in 2023-24 GDP, how strong is the export growth likely to be in Q3 and ahead, or how strong was it in Q3 and going ahead? What's it going to look like, and how much of a dent will Trump's actions have in the coming months?
Yeah, so exports till now have been growing strong. We've talked about the quarter three numbers, and also the second advance estimates peg exports at a higher growth as compared to the first advance estimate.
Right.
But going forward, when we have the provisional estimate, then we might see some downward revision in the export numbers when we'll have the full impact, because every day we are getting to hear new set of information
Yeah.
about what are the kind of tariffs, and there is this expectation that sectors like pharmaceuticals, textiles, precious stones, engineering goods, electronic goods, they will be hit by uh, tariffs. And though there is a parallel talk about bilateral agreement, but that won't stop the US from imposing tariffs and also reciprocal tariffs. So once
Yeah.
the design of reciprocal tariffs is clear, the implication of tariffs on overall exports will be seen. There are these various numbers, various predictions going around, but ultimately the impact will be seen when the actual tariffs kick in, and that will kick in from the month of March and subsequently in April
In
as well,
April,
the
yeah.
reciprocal tariff. But we know for sure that there are some sectors which we discussed earlier will be impacted, and therefore, and they are sectors that have a sizable presence in the US market. I mean, US is has a sizable share in those sectors, so there will be impact in terms of overall exports in terms of slowdown.
Okay, and Aditya asks, he says experts have said that the increase in GDP rate in this quarter is because of increased spending by the public. Of late, we've been hearing that public consumption has been reducing. Is the Q3 increase due to the festivals? And can we see this trend rise in the final quarter as well?
To some extent, it is due to festivals, but if we look at the overall level, also there is an increase in consumption. If we look at the private final consumption expenditure, there is an increase in level. So it is not just festivals, though it is a part, but it is not just festivals.
Right.
A part of it is also to do with the buoyant rural consumption, and some part of urban consumption is also picking up. But beyond that, we cannot segregate. But going forward, a lot of it will depend upon how manufacturing sector will perform, how the labor intensive sectors will be hit by the tariffs, and therefore it will have an impact on employment generation and on consumption going forward. But as of now, consumption is quite okay in terms of both the third quarter as well as the second advance estimates, where we saw that it has been revised upwards by 30 basis points.
Right.
And in level terms, also there is an increase which is due to festivals, weddings, rural sector, and to some extent urban consumption as well.
Okay, so there you go. Now, I'm not going to recap all of the numbers, there are just far too many, but there are a few policy things that are important to mention. Number one is that because the data has been revised, now we know that the slowdown in this financial year is expected to be more drastic than we initially thought. Where last year's growth was pegged at 8.2%, it's been revised upwards to 9.2%, which means that the 6.5% that's expected this year is that much slower. So that's a big policy concern for the government. And the other thing is that for the previous 2 years, 2022 23, and to an extent 2023 24, the revisions have been quite substantial between what they initially expected and what the final number is. And this again makes policy making that much harder because you don't quite know how the economy is doing, how each sector is doing. So there's some things for our statisticians to think about, our policymakers to think about, how do we make our initial targeting better so that it comes in line with what the final number actually is. But on that note, that's all from us. Thank you so much for watching.